I want you to take us through some of the less successful investments that you've made and what you learned from those.
I always say this, that I probably have way more losses than gains. If I sit here right now, I'd say I probably have more losers than winners. But, and it's a very, very big but, when you know you have a winner, you focus. You just keep pushing. You keep pushing.
Eric, the Sprott name is synonymous with investing in precious metals, but you weren't always involved in precious metals. And I want to go back a little bit and look at how you got involved in this sector. You started off as a CPA, and then eventually you became a research analyst. And then in 1980, you made the decision to go out on your own and start your own firm, which eventually became Sprott Securities. Tell us about this time and why did you make the decision to go out on your own?
Well, why did I make the decision to be on my own? I think part of it was the company I was with at the time really didn't want to do underwritings, okay? And I was a guy who would have my own individual ideas, and I'd get close to the companies and a big investor. And when the opportunity came along to do some issue, if I'd stayed where I was, I couldn't do the issue. So I decided I should do it on my own. And most of what I did in terms of ideas was self-generated one way or another. It might have been because somebody mentioned something and you follow up on it, or something you noticed in an earnings release or some newspaper article or something. But I mean, I was a bit of a hound looking for things where the market was mispricing securities.
Were you focused on any specific sectors at that time, or?
Initially, I wasn't, other than typically you had to be looking at small companies because small companies are companies that people aren't looking at. And, everybody covers the banks and the big companies in Canada. Well, what am I going to add to the thing unless I have my own stable of companies that I can look at? And typically, because they were underfollowed. In fact, one of the great things that I look at in a stock is to find out that nobody covers it. And that's always a great sign for me, because if you're sitting here looking at a great opportunity, nobody follows this, okay, I think I know where this is going to go, providing the story holds together. So I did that. I worked very hard at trying to find things where you're stealing value. And I use that phrase advisedly. When you're buying things that are cheap, you buy something at $1, it goes to $10, you've stolen a little bit of value from somebody. I mean, I don't mean to steal from the guy, but the opportunity presented itself and you get in there and take advantage of it.
In the 1990s was a fascinating time in the financial markets. This was the beginning of the internet bubble. And in 1995, one of the first companies to go public was Netscape. That was a internet browser. And on the very first day of trading, it was up 100% from its IPO price. And this really became symbolic of that whole time period. Every company that went public was up 100% or 200% on the very first day. In between 1995 and the year 2000, over 1,500 companies, most of which were tech-related or internet-related, went public. And it was also during this time when you were still running Sprott Securities, but you started focusing more on money management. Right. And eventually you started your asset management company, Sprott Asset Management. What was the impetus behind that, and why did you start focusing more on managing money?
Well, I was a successful manager, and the allure of earning a 2% fee and 20% of the profits was a little compelling, and we'd run a long-only fund for quite a while. It had done very, very well. And I'd always be competing with the best guys around us who would be the best portfolio manager that year. And very often I was, and other times other guys were. And those were long-only funds. And of course, once it looked like the whole NASDAQ thing was going to crash, you're wondering, well, what am I going to do to save my customers here? I think stocks are going to go down. They ultimately went down, I think, over 80% in the whole NASDAQ thing. And I decided that I better be long gold and silver and short the market. And the funny part about 2000, 01, 02, I mean, they were incredibly profitable years for us. I mean, they were just crazy profitable because everything, I mean, there's so many stocks that went down, like huge amounts. Like you talk about all those stocks that went public. I mean, if there was 1,800 of them, I'm sure 1,700 of them went broke ultimately. So there was an opportunity for being aware of how overvalued things were.
And before this time, you didn't really focus on gold or silver. Why did you start looking at gold and silver then as an asset class?
Well, the funny thing is, it was a survival thing, right? What survives a bear market? And to think that I got seriously into it in 2000, I bought gold in 2000. We bought lots of stocks over that time period. And it's something that, quite frankly, as I look at it today, 24 years later, it's still what we do. And why do we do it? Because one, we had 2000, two, we had 07, 08, 09. And now we have this other bubble that's probably going on. And what's ultimately going to happen when that bubble gives it up? And where are we going to find refuge? And it would appear to me, as I notice that the gold stocks, gold, silver, are the best performing groups so far this year. And I think it's just begun. And we haven't even had the tip over in the market yet. But I suspect that will aid and abet the interest in precious metals.
So I want to talk about this in a little more detail. As you mentioned, the time we're living through right now is very reminiscent of the 1990s and the tech bubble. And when you look at what's happening right now, we're not focused on internet stocks, now we're focused on AI. And the poster child for AI is NVIDIA. The market cap is around $3 trillion, $2 trillion of which came just this year alone. It's trading at 40 times revenues, and it represents approximately 12% of GDP of the US. And when you look at this situation and just the overall situation, tell me about some of the similarities you see between what's happening now, what happened back in the late 1990s, and what you're doing to profit from it.
Well, in the NASDAQ bubble, what was it? The metric they used was eyeballs that are looking at you, something like that. And you just knew the minute they had to use that as a metric that something was amiss. And when I think about, I'm not an owner of NVIDIA, I'm not short NVIDIA. When I think about the valuation that has been ascribed today and what they'd have to earn to justify it, we're not talking 40 times earnings, we're talking 40 times sales now. That's a very tough thing to imagine, that anything could be worth 40 times sales. And anytime that anything else was at 40 times sales, trust me, it probably ended up at 2 times sales shortly thereafter.
And do you have any other examples in terms of valuations when you look at the market right now and how it compares to the late 1990s, things that might concern you?
Yeah, sure. Well, I would say, when you hear what people are doing, what the individuals are doing, buying one-day options, I mean, that's just out and out gambling, man. You're gambling the stock's going to do something that day. And if you're wrong, you're going to lose 100%. If you're right, you'll make 100%. But you're more likely to lose because every time you buy an option, you're normally out of the money. It has to work for you to make anything. And if it just stayed where it was, you're going to lose everything, typically. So it's just such a dangerous thing that everyone wants to do that these days. And you've got these algorithms that are trading based on, I don't know what, they got their own formulas, right? Maybe one of the formulas, the price of the dollar goes up, you short gold, that sort of thing. And then, of course, then they find out that didn't work after all, because they did have it wrong. But it's all pre-programmed. They got huge amounts of money, so they can affect stocks in a very significant way. I've always believed that, to a great extent, markets are manipulated. And they're manipulated by the gargantuan money holders, the brokers, the banks, who are. I was wondering, well, how can the Canadian banks keep making 15% more every year? Like the population only grows 1.5%. How are you skinning them that successfully? How does the whole banking industry keep getting that much bigger all the time? You can only get so much out of the stone, if you know what I mean. So you kind of get a sense that manipulations always end. And maybe if NASDAQ was manipulated, which it probably was, it ended back in 2000. If the debt bubble of 07, 08 was manipulated, which it was, because they were convincing people to buy stuff in the bonds market that was junk, and it all became junk. And you could see it was junk. And much as many people say you couldn't see it forthcoming, I brought along a little book of write-ups that I did at that time. And I haven't looked at it in quite a while, but I noticed I had a write-up written on March 7th, 2000, when I said the market is way too speculative or speculative excess, something like that. And they closed. I said, don't be a part of it. That was the day the market peaked out. I got other articles that I've written about, buy gold and buy silver, and there's a housing bubble going on here that nobody could foresee. But it was so obvious. There was even websites, housingbubble.com. You could go there and read the stories of what people were doing in the housing market, where all these people are buying 3 and 4 and 5 homes and thinking they're going to make it big. And of course, we had that in Canada not 2 or 3 years ago. Everybody wanted to own a home that they're going to rent. And of course, the rates go up and the whole thing doesn't work anymore. So
One of the big differences between now and the late 1990s was probably the number of IPOs. And at that time, they were doing an IPO like every day, sometimes 2 or 3 a day. We haven't really seen that this time. Now it's really concentrated on a select few names. NVIDIA, Microsoft, Apple, Amazon.
It's funny. I've never quite put it this way before, but I know that IPOs kill markets because they take money out of the system, right? That you can't get to keep sloshing around anymore. And it's funny that we have a situation now where we don't do IPOs, but we all have buybacks. Well, that really helps valuations, okay? Because now you keep throwing money back into the market, and no one's taking it out because nobody does an IPO. So both of those things, which are like they're big features of the market, the buybacks. I mean, I see where Microsoft announced a $60 billion buyback the other day, and stock goes shooting up. But that's the game. I mean, you got to have a buyback. You don't do issues. And it's a big issue, just sucks money right out of the market. It doesn't come back into the stock market. When you give XYZ $100 million to go build a plant somewhere, that's not coming into the stock market again. It's gone. So it's a negative liquidity event, an IPO.
As you know, markets always move in cycles. And you mentioned earlier about the NASDAQ topping out in March of 2000. It lost 80% of its value in a relatively quick period of time, I believe 2 years. At the same time, gold bottomed in the year 2000 at $252, and it moved up right up until 2011. I believe it topped out around 1900. And so we had the NASDAQ going down at the same time gold was going up. Do you envision we're at the same sort of time period right now where we might be at an inflection point where the NASDAQ is close to topping out, maybe it already has, and it's going to start moving down significantly, and at the same time, we're going to see another major move in the price of gold?
I think the move in gold is easier to predict than when, the Mag 7 are going to roll over, although I suspect it's soon. And the reason why I think gold is easier to predict because you have fundamental changes happening here where it used to be in the early 2000s, central banks were sellers of gold. Now they're buyers of gold. And the gold production hardly ever goes up. In fact, silver production seems to keep going down. You have a weak currency, the US dollar, and in fact, every currency is effectively a weak currency. They are lucky that they all get to compare themselves to each other because they're all weak and you're irresponsible governments pretty well at every level. So I would say the impetus to own gold is incredibly strong right now. And I would suggest that if the market does break, the impetus to own gold will increase. And in fact, I always mention that the gold stocks have outperformed everything. And I always find it funny. People say, well, why don't they notice? Why don't people notice that? I always say, well, there is one group that notices. It's the computers notice. When you get the handout every morning, what's working and what's not working, and the gold and silver and gold and silver. And then finally, people catch on. And we see that amongst some of the smarter guys in the business that have committed to owning gold shares that would typically have been growth guys, but even the bond king, Grunlack, He likes gold. He can see where it's all going. He's the bond king, but he likes gold and is reasonably outspoken about it and confident about it. And there's a lot of, you can feel the interest building here. And of course, as you know, through the experience of watching financial markets, when something starts working, I mean, everyone eventually gets there and you get some kind of blow off. And I think the targets for gold, if we go up as much as we did in the last two bull runs, we have a long way to go in terms of pricing of gold and silver. And perhaps it'll be more exciting for silver in my mind.
So let's talk about the performance of gold. It's up 25% on the year, which is okay. It's not Bitcoin-like, but it's a respectable move.
Better than Bitcoin this year.
But we have seen a lot of the producers, I'm going to talk about the big caps, Newmont, the world's largest gold producer, it's up in line with the price of gold. Barrick, the world's second largest gold producer, it's small in the year, nowhere near the performance of gold. What do you think's happening there, and why aren't these equities catching more of a bid?
Well, I've said this before, that I think the big companies have cast a pall on the investment in gold because they have underperformed. I think Barrick used to produce 8 million ounces back in 2000. Now they produce 4 million ounces. Well, that's not exactly a formula to make a excessive return. Some of the countries have had difficulties with acquisitions that were mistimed. It's tough to find gold. You know, if you're going to be a big company and they're going to go out and drill, the likelihood of being successful is not high. And the cost of drilling is expensive. So they kind of sit in the weeds and wait to buy something. But I'm always surprised that, I'll give you the example. I'm the chairman of Kirkland Lake. We have purchased the Fosterville mine in Australia. It's so obvious to me what kind of money we're going to make year, 2 year, 3 years out. The stock was, let's say, at $10 or $12, and nobody approached us. Nobody approached Kirkland Lake to consider buying it now that we had Fosterville. And of course, all of a sudden we started producing from Fosterville. The grade's just beautiful. And stock goes from 10 to 70 without a whimper from any company. Nobody knocking on our door. I don't get why they wouldn't. The data was there to see what we should produce, so we knew what the grade was going to be. It's right at the existing mine. It was pretty well a layup in my mind. And of course, that was a tough time for the gold stocks too. I think we're probably talking, 2015 to 2020 when everything was just awful, except for Kirkland. And finally, I found it rather odd that I was no longer the chairman when Agnico bought it and paid no premium, which I thought was kind of weird. I suspected it wouldn't happen like that if I was the chairman, that we would sell it for no premium. Or maybe we'd still exist today and because no one would buy us. But there's lots of opportunities, but the big companies seem to be asleep at the switch. I would say that now. I have some companies that I really like, and I'm loath to talk to a big mining company about them. I don't want a bid on certain things because they're so cheap. Like, let's let it play out here. I might have a stock, one stock that is a favorite of mine, is Free Gold, trades at $1. They just came out and said they had 30 million ounces, but they actually cut it back and said, well, let's call it 23 million, but it really was 30. And in Alaska, beside the Fort Knox mine that Kinross has everything. And it was trading at about $10 an ounce in the ground. Oh, why wouldn't somebody buy it? Why wouldn't? You can't find gold for $10 an ounce. Why? What's wrong with Alaska and 25 minutes from Fairbanks and road there and the state that likes mining, but no one's. Well, I know lots of people have met with the company just to chat, but no one's ever gotten serious about doing anything, which is fine. I'd like to see the stock go from $1 to $10. And
Eric, in 2017, you started the Sprott family office, and since that time, you have invested over $1 billion in more than 175 different mining companies. And it's often said that you can learn more from your failures than you can from your successes. And I want to look at some of your...
That's why I'm so brilliant.
I want you to take us through some of the less successful investments that you've made and what you learned from those.
I always say this, that I probably have way more losses than gains. I do have probably more losses than gains as we sit here right now. Okay. I mean, I might be able to come back here 3 years from now because I rarely sell anything and say, oh, it all worked. As the price of gold is $3,800 and everything's levitated by 500%, then fine, I'll be okay. But if I sit here right now, I'd say I probably have more losers than winners. But, and it's a very, very big but. When you know you have a winner, you focus. You just keep pushing. You keep pushing. And so, I mean, I have companies that I own 45% of, 30% of. I got many that I own 20% of. I bought 2 this week where I already had like 13 or 15%, and I went to 20. I said, okay, it's coming together. Price of silver is going up, or this guy's got a new thing happening, and it's all looks like it should work out. And so I go deeper. I might own 300 different companies, but I put new money in 2 of them. And it's more than that. I mean, this year I probably put money in whatever, let's say 10 different companies. And of course, those 10, when it's big money, sometimes I'll just, do something to help a guy, that needs $500,000 or $1 million, something like that. But when you're writing 5s and 10s, you know that you're actually giving it some thought here, and it's purposeful. And so I am always re-looking at the things you own and what's happening here and why is that stock starting to move? And they're phoning up the manager. Oh, you got some new drilling going on. Well, okay, let me go take a look at the drilling here, and I'll, go back and review it. Okay, this is starting to make some sense. So fine, maybe I'll just amp it up a little. And that's what you do. You keep pressing the bet is what you do.
But is there
I do the same thing when I'm at the casino, by the way. When I'm at the casino and I have their money, I bet more.
But is there one particular name that, when you look back over your career, that you took a big hit on?
Oh, I got lots of them. I mean, the most recent one is pure gold mining, where I probably had a position that at one time was worth $100 million. I may have put, I don't know, 30 million in it, cash, or 40 million. I don't know what the number was. And they had a wonderful property up in the Red Lake area, and we thought it'd be like the Red Lake mine and wonderful drilling, and we're all going to develop it. We raised the money, and then for some reason the mining didn't work. Now, I can't explain to you why the mining didn't work because I'm a mere chartered accountant. Okay, so I don't know what went on underground there, but it didn't work, and they couldn't seem to generate new interest in it. So they filed for bankruptcy. I don't think there was a real lesson. I mean, I have to, when it comes to the mining, I have to trust people. I mean, I can look at the drilling and I can maybe have some judgment of whether it hangs together or not. But I have to rely on people in the business, geologists, mine planners, mine engineers, to have it manifest itself. And if there's some weakness, I don't think I'd sense it early. I might sense it early. There could be things that put you a little bit of alert that maybe it's not going like you thought it was going to go. So, and lots of things can self-correct. Maybe had I hooked up with Frank when he reinvested in it, maybe they will find a way to resuscitate it. I wish them well.
And Eric, when you take a big hit like you did on pure gold, how do you recover from that?
Well, you got to find a winner. And of course, you got to remember, I came off a big winner. I had a big winner in Kirkland Lake, so I could afford to have that $20 to $40 million loss because they had the huge winner in Kirkland Lake. And I got lots of other things that are doing well these days. So the portfolio is for sure going up, but I probably have some stragglers in there for sure. But I still hope that even the stragglers will come around in due course. We are dealing with a commodity that looks like it wants to go up in value. So any ore body, if you've got a resource there, it's funny when that all of a sudden it tips over that, okay, the thing makes sense now again, and everyone will come back in. And I would say anybody with an ore body, they got to be looking at it like it could be, it should be economic here. One of the things I sort of raise my interest when a guy says I have a mine on care and maintenance. Oh, really? That's an easy switch. Surely to God, at $2,600 gold, you put in care and maintenance when it was $1,500 gold. It's got to make some sense now.
You made mention of Kirkland Lake. That was a big winner. How big was it?
Well, I would have made over $1 billion. I don't know the exact number, but it would be over $1 billion for sure.
And what was it about that particular name that caused you to make a big bet on it and stay into it for so long?
I was in Kirkland long ago. I liked the ore body. I like where it was, Kirkland Lakes, high grade. The real change was when Fosterville came along, and I was already an owner in the Australian company. So as chairman, I said, I think we should take a look at this company down in Australia. And we ultimately did. Somebody else beat us to the punch the first time. I think it was a group out of Vancouver that bought it before we bought it. We bought it from them. But we probably should have moved a little faster because it seemed quite obvious to me that it was a very, very, very special ore body. I mean, the grades were just crazy. And one of the beauties of grade, so for example, I'll maybe use Jaguar as an example where we have an ore body, we're mining something that's, let's say, 3.4 grams, but we think we might be finding an ore body right beside it, contiguous, like a stone's throw away. So you can mine right there. That could potentially have, well, at least 50% more gold than what we're mining there. I said, okay, fine. Let's take the guys that are doing that there, go right sideways here and mine that, and we'll get 50% more gold out of that thing with no extra cost, other things being equal. So it produced an extra 15,000 ounces from that thing, and it'll be free. And at $2,600 gold, I don't know what that is, that $40 million extra from the little thing, an extra 15,000 ounces, but it's $40 million. So fine. That sure helps a stock that was not that long ago trading at, let me just do the math here, trading at about 120 million Canadian, where all of a sudden you could get 40 million from this little development, let alone that development or this development, all these things that start falling into place that add quantum amounts to your bottom line.
When you make an investment or when you're looking at a specific company to make an investment in, what are the top 3 things you look at before you make that investment?
Well, it all has to start with the opportunity. Like, why is this an opportunity? What is it about that investment that makes it interesting to you or undervalued? And I've already mentioned free gold. And I remember my partner came in and said, Eric, we've had this company that came in to visit us at Paradigm, as it turned out. And he says, they say they got 6 million ounces and the stock's trading at $6 million, i.e. $1 an ounce. I said, let's buy 25% of it. What's the name again? I knew nothing about it. And it was funny that the president, Christina Walcott, she was presenting at Beaver Creek, and she was reminding the listeners that in 2019, Eric came in and bought 20 or 25% of the company at 6 cents a share. And at the time, it was trading at 90, like now. It was trading at 90. So there's a 15 bagger right there. And now, of course, now they got 30 million ounces. And in my own mind, I can conceptualize readily that they could have 60 million ounces because they got the 30 here and they say, we got a thing just as big over here, possibly higher grade, maybe higher up in the elevation. So my mind says, okay, it could be 60 million. Nobody's paying for it. I mean, they're only paying $10 an ounce, not even paying $10 an ounce for the 30 million. What if it's 60? Now it's $5 an ounce. Fine. Let's keep investing. Makes it fun when it works out. There are not too many where you could go from 6 million to 30 million in 5 years, but that was the case in that situation. And I would have bought many issues in that stock. I bet I'd have bought 5 of them. And most of them, I would be going to them saying, why don't we do an issue here? I'd like to get a little more money in this thing. In fact, I exercised some warrants recently, a year early, which is insane from a portfolio manager's point of view. But I wanted them to have the money so they could do the drilling and not have to go to the market and get beat up doing a stock issue where, they issue it down 15% and they got to give the underwriter a warrant and a big fee and whatever. And all they do is sell it at the lowest common price.
So this is a prime example of where you see value.
Yeah.
I think the term you used was
Value, stealing value. Yeah.
Eric, one of the fascinating things about financial markets is that you can make money so many different ways. And Warren Buffett made his money by focusing on value. Carl Icahn made his money by becoming an activist. You made your money by focusing on resources.
I thought you were going to say focus on stealing. But I do.
Regardless of what asset class you look at to make your money, there's probably certain traits or characteristics that are required to be a successful investor. What do you think they are?
Well, you got to be a numbers guy for starters, okay? If you're not a numbers guy, you'll never even notice the anomaly because you're looking at something. You better figure it out right there, okay? Because if you want to keep looking at different companies, that's your one chance to figure out there might be a serious opportunity there. If you miss it because, I'm afraid of math or whatever, and I'm used to doing those kinds of things. So looking at where I always look at what's the company cost me today and what should it be worth somewhere down the line. That's the payoff, okay? Now, I don't have to own the whole thing, but I know if it's, let's say, worth X and I think it's going to be worth 50X, it's going up 50 times. I mean, I may only own 10% of it, but I know if I thought something was going to go up 50 times, I'd own more than 10%. That's pretty simple.
So being analytical is very important.
Being analytical is important. I think one of the great things about being a Canadian is we focus a lot on resources. And I certainly noticed, and I'm sure many of the people who would listen to something like this would realize that the payoff in resources is outsized. It's just outsized. If you find it, the return is incredible. So that the reward to the hunt, if you find it after working hard to find it, I'm talking as an investor now, not the guy out pounding the ground with the drill core, but the guy who reads the results of the drill core, that payoff can be very, very substantial. And one of the things I find is that everyone might say, well, you're not a geologist. I say, well, I have a view of what happens when a geologist finds a big discovery. He tries, how did that get there? Where did that come from? What is that? And Eric's sitting there saying, oh my God, look at the ore's worth $1,200 a ton. This thing's going to go way up here. Because you're just immediately put it in numbers. Because it's a numbers game when it comes down to it.
Something else that really stands out to me when I hear you talk about Kirkland and some of your other investments, you mentioned earlier that you never sell, but it sounds to me like...
I rarely sell. You have to sell sometimes.
It sounds like patience
yes.
is also a required skill.
Yeah, it takes, particularly in the mining business, right? I mean, just think of how long it takes for an ore body to go from initial, not even discovery, initially staking, and then discovery, and then all the work you got to do to flush out the 43-101, and then the effort you got to do to get the mine permit, then the effort you got to do to get the mine in place. I mean, it's a long, long process. It's probably at least a 10-year process.
So we are living through extraordinary times.
Yeah.
And our governments all over the world have pumped trillions of dollars into the financial system. And as a result, we have bubbles all over the place. And I'm sure you would agree with me when I say the bubble that we're experiencing right now is greater than any bubble we've ever seen in the history of mankind.
I think it would
and
fall
Tulip Mania in the 1600s, the South Sea bubble in the 1700s.
And I don't know about the Depression of 1929. I do know very much about NASDAQ 2000 and the great financial crisis. And this one, of course, is bigger than them all because we just keep expanding the derivatives and the funny instruments, and the average guy investing is taking way more risk than he used to be. Way more risk.
And to your point, it's just not one bubble. It's in so many different things. It's cryptocurrencies, it's NFTs, it was the metaverse. Like there's just so many. And now it's AI. So how does it all end?
Well, it'll all end by something happening in the credit markets, is my guess. Okay, that we've seen the 10-year bond actually pick up a little here in yield. If you still got to issue the bonds every quarter and week and whatever, and somebody got to buy it. Well, if the guy who used to buy some of it was the person who was a saver who's now a negative saver, he ain't gonna buy any. And if the Chinese used to buy it, they don't buy it. The Indians used to buy it, now they don't buy it. Of course, the Russians can't buy it. But there's a lot of people who now are in a position where they might regard it as being responsible to not buy the U.S. debt. That's becoming more obvious by the day. So it's going to be something to do with the bond market and interest rates and defaults, things like that. Whether the whole commercial real estate thing comes to pass, whether maybe you'll get a crash in housing prices here as people realize, they all hope that, we're going to get a cut in the Fed funds rate and housing prices will go up. Well, so far they haven't. Fannie Mae came out and said they're not, the house sales are not going up this year. They're not going to go up because people are just too stressed out already. They need rates a lot lower than they are.
And how are you personally positioning yourself during these tumultuous times?
Well, I'm a very irresponsible investor, and I have probably 90% of my funds in gold and silver. Which has gone from 250 in 2000 to 2,600 today, so it's only up 1,000%. I still and going higher. I am short some stocks in the market here, but a very small part of my total portfolio probably wouldn't. It's probably like 5% of my portfolio might be short stocks, and I've lost on them, of course. But, you got to be patient. I've been short lots of things before and had them shoot up on me, only to find out that they went down. In fact, when I was re-reviewing some of the stuff I wrote back in 2007, one of the articles I wrote was Dead Men Walking. I said the following companies are broke: General Motors, Fannie Mae, Freddie Mac, Citigroup. And that was in probably 2007, 2008. They all went down to $1 a share. They got bailed out, of course. They were broke, but they got bailed out. It's amazing to think that we had the bailout of in NASDAQ, the 2007, 2008, where we get quantitative easing, and then the COVID thing, we just throw money all over the place. And in fact, even now, the governments are throwing money all over the place with no reason to have to do it. They just like doing it. So, yeah, we got a big bubble here. People should be careful.
Eric, you've had a very successful investing career. If you were 30 years old again, would you do anything different? Would you focus on another asset class maybe?
Well, with the way we are today in the world, I wouldn't be focusing on a different asset class. No, this is exactly the asset class I should be focusing on. In fact, I'd tell any 30-year-old, get with the program here and figure out what's going on in the precious metal space. That's what I would do for sure. Now, that doesn't mean it's going to carry on forever. Maybe, it goes up and all of a sudden the economy sinks and other values are created. There's other things that have gotten very cheap that they should consider. And that I think that's what it is. You got to hunt down the opportunity. Where is that next opportunity going to be? And I'm not saying it's easy to notice it and act on it, because I've been lucky. I can spend 24/7 a day thinking about this stuff. The average guy can't. The average guy's got to find someone who knows what they're doing and stick with them. That's probably the best advice I can give them. And it's not easy to find the guy who's going to work all the, even myself, because I focused on precious metals. I mean, there's lots of times when it's not working for a year or two. To me, I can write it out. I don't mind. I can deal with losing money if I think the opportunity is outsized to make money. It's just part of the game. Most people can't deal with that.
Well, Eric, that was a fascinating discussion, and I want to thank you very much for spending time with us today and sharing your thoughts on your career and also the financial markets.
It's been fun. Thank you, Jimmy.